Silver is entering 2026 in a position it has not occupied for decades. Across multiple currencies, it is no longer behaving like a forgotten industrial input. It is behaving like something the market can no longer ignore. Prices are rising not just in dollars, but relative to gold, relative to equities, and relative to confidence in the financial system itself. This shift forces a serious question, not whether silver moved in 2025, but what that movement actually means for the year ahead. Because this move did not happen in isolation. It happened while equity markets stretched valuations to historic extremes. It happened while sovereign bond markets showed visible stress. And it happened under monetary policy conditions that no longer resemble stability, but improvisation. When an asset begins to act differently in a distorted environment, the behavior deserves attention. For more than a decade, precious metals existed in a stalemate with equities. Gold and silver moved, corrected, and moved again, but always within long horizontal ranges. Every rally was eventually sold. Every breakout attempt faded. The stock market, particularly the S&P 500, dominated capital flows and investor psychology. Metals were tolerated, not respected. That structure broke in late 2025. Gold relative to equities broke out of an 11-year range. Gold mining equities followed. Silver then joined the move, not only against stocks, but against gold itself. From historically depressed levels, silver began to outperform. This matters because it suggests that 2025 was not a top, but a release. A lid that had been held down for years finally came off. The next layer of the story is structural, and this is where silver differs sharply from gold. Gold is mined primarily as gold, silver is not. Roughly 70% of global silver supply is produced as a byproduct of other metals such as copper, lead, zinc, and gold. This creates a unique constraint. Higher silver prices do not automatically generate new supply. Mines do not suddenly expand silver output unless the primary metal economics justify it. Meanwhile, primary silver deposits have seen declining grades, rising capital requirements, and increasingly long permitting timelines. In simple terms, silver behaves like a monetary asset on the demand side, but it behaves like a secondary industrial afterthought on the supply side. That imbalance has existed for years, but it becomes dangerous when demand changes. And demand has changed. Silver is now a critical input for industries that are not optional. Solar energy, electric vehicles, data centers, advanced electronics, and defense systems all rely on silver in ways that cannot be easily replaced. These are not uses that disappear during economic slowdowns. They are embedded in long-term policy decisions and capital commitments. For manufacturers, higher silver prices are not the main risk. If the silver content in a product rises from $1 to $4, the impact is negligible. The real threat is not cost. It is availability. Production lines cannot function without supply. This is where geopolitics enters the equation. For many years, China played a quiet stabilizing role in the silver market. When prices threatened to accelerate, refined metal flowed out of the country. This export behavior helped cap volatility. It kept silver trading close to production costs. Industry veterans have noted this pattern repeatedly. That mechanism changed in late 2025. China introduced a new licensing regime governing silver exports. At the same time, India rapidly expanded its role in solar manufacturing under government incentives. Domestic silver investment demand in India surged through exchange-traded products. Combined with an already visible structural deficit, this represents a transition, not a tweak. A supply channel that once acted as a pressure valve is now tightening. At the same time, futures exchanges have become more important sources of physical silver. On COMEX, increasing numbers of participants have stood for delivery. Tens of thousands of tons have been demanded in recent cycles. Notably, open interest has often declined during price advances. This suggests leveraged traders are stepping back. Physical users are stepping forward. This changes price discovery. When industrial buyers begin sourcing directly through futures markets, it signals distrust in spot supply. Physical premiums become more relevant than screen prices. Paper prices may still exist, but they lose authority. Against this backdrop, it is tempting to dismiss silver's monetary role as secondary. That would be a mistake. Silver is beginning to behave like money again. Investors are increasingly thinking in ounces rather than currencies. That psychological shift is critical. It reflects doubt in the long-term purchasing power of fiat systems. This doubt is not abstract. It is reinforced daily by fiscal realities. The United States is running annual deficits exceeding $1.8 trillion. Japan's bond market has shown signs of strain as yields rise. European sovereign spreads have widened at politically inconvenient moments. These are not isolated problems. They are symptoms of systems built on assumptions that no longer hold. Equity markets add another layer of risk. The U.S. stock market spent much of 2025 oscillating near its highs. Marginal new peaks were followed by stagnation. Historically, such behavior often precedes major turning points. If equities weaken materially in 2026, the psychological impact could be severe. Household wealth and retirement expectations would be hit. Retail investors are usually late to recognize currency debasement. They often believe metals are rising rather than currencies falling. But once that realization spreads, demand can shift rapidly. So, what does this mean for silver in 2026? Precise predictions are not useful. What matters are forces. Industrial demand will continue expanding regardless of short term cycles. Solar installations, EV adoption, and data infrastructure are driven by multi year commitments. Silver thrifting will continue, but higher efficiency technologies still require meaningful amounts of silver. Recycling will contribute only marginally. Most industrial silver remains locked in long life products. Substitution remains limited. Alternatives exist technically, but often carry performance penalties. Manufacturers resist those trade offs. Monetary demand is likely to broaden. Central banks already hold record gold reserves. Retail silver participation remains modest in the West, but interest is rising. Living costs have undermined trust in official inflation data. In Asia, this shift is already visible. Silver investment products have expanded rapidly. Physical buying remains strong. Supply constraints remain unresolved. Mine grades continue declining. Permitting remains slow. Byproduct economics limit responsiveness. If industrial users begin stockpiling, availability could shrink faster than expected. Exchange inventories have already shown stress. Periods of backwardation have appeared more frequently. These are subtle but important signals. The likely outcome is that 2026 will not be smooth. There will be pullbacks, some sharp. There will also be rallies that extend further than comfort allows. The danger is not volatility. The danger is waiting for perfect clarity. This is a market undergoing secular repricing. 2025 now looks less like a climax. It looks more like a prelude. Silver has begun expressing its dual identity. It is an essential industrial input. It is also a monetary hedge in a world skeptical of official promises. These roles no longer conflict. They reinforce each other. When investors and manufacturers compete for the same ounces, old frameworks fail. The pricing structure of the past decade becomes obsolete. Silver is no longer the metal that might move someday. It is already moving. And the forces that drove its behavior in 2025 remain firmly in place. As 2026 begins, those forces are still active. If last year was silver clearing its throat, the coming year will show who was paying attention.
So friend, welcome today my new video and welcome. This is Friday. So friend, silver is entering 2026 in a position it has not occupied for decades across multiple concurrents. It is no longer behaving like a forgotten industrial input. It is a behaving like something the markets can no longer ignore. Prices are rising not just in a dollars but relative to good, relative to equates, and relative to confidence in the financial system itself. This shift forecasts a serious questions, not whether silver move in 2025, but what that movement actually means for the year ahead. Because this is move did not happen in isolation, it happens while equity markets strategy violations to strict extremes. It happened while serving board markets showed visible streets, and it happened under monetary policy condition that no longer resemble stability but improve position when analyst begins to add definitely in a distort anymore the behavior deserves attention. Thank you so much.